Welcome to Financial Issues, where we help you steward faithfully by honoring God with your investments. Now listen in as we give you the practical tools and advice you need to become a biblically responsible investor.
This is Financial Issues, where we help you defund darkness and fund the light by investing with biblical integrity. Welcome to the show, everyone. It's wonderful to be here with you. Seth Udinsky and Sam Case, and hopefully very soon, live from NRB, our host, Mark Minnella. Sam, great to be here, brother. It's exciting
Fantastic
stuff.
to be here. Hopefully, Mark can grace us peons with his beautiful presence.
Absolutely.
He is a very famous person down at NRB, though.
He sure is. We'll be excited to get to be checking in from Mark here. Here he is now. I think, Mark, can you hear me?
I can.
Oh, my goodness, this is great. What a joy. Folks,
The legend
your host,
himself.
Mark Minnella, he's here. We had a little bit of a technical uncertainty there. We weren't sure if we were going to be able to get him, but we've got him. Mark, great to have you, brother.
Yeah, and it waited right till the show started to happen.
Right.
So we know
Exactly right.
we know we're on the right track.
Yeah.
Because
We just like a
obviously
little bit of drama.
It's not wanting us wrong. Yeah, we're at NRB here. That's the National Religious Broadcasters Convention here, which takes up almost all Opryland, which is really cool. Very exciting. There's all sorts of vendors, people from all areas of the Christian community, and we're here. Already ran into some old friends last night, which will be good from the Timothy plan, and looking forward to this whole thing, to make some new friends, maybe come alongside, partner with some new people. It's going to be exciting and fun.
It's great stuff. Folks, please keep Mark and our CEO, Michael Cardinal, in prayer. They'll be at NRB for the next couple days. Mark will be broadcasting live today and definitely Thursday as well. So we're so excited to get to still have you on the show, Mark. It's awesome. Folks, listen, phone lines are wide open. So give us a call, would you? 610-363-1110 if you want to talk to Mark and ask your financial question. Jump the line, as it were. If you've put a question into our portal and you haven't gotten it answered yet, call in right now. 610-363-1110. A couple things we'll be talking about today, guys. What is over-diversification, and how do we remedy a portfolio that has become too diversified? Mark, I'll be excited to hear your thoughts on that. First and foremost, though, guys, Sam, interesting stuff we're seeing. It looks like tax refunds are up for this year. What can you tell us about that?
So the IRS says, they say it's up right at this time about 11% higher than last year. The amount of money that people are getting is 11% higher at this time right now than it was at the same time last year, with Treasury Secretary Scott Bessent saying that increase could be as high as 22% when all is said and done. As of February 6th, the average refund was just under $2,300. Total refunds, meanwhile, are nearing $17 billion, and that's up about 2% from 2025. So, Mark, my question about all this, listen, I love to get a tax refund, but is there such a thing as too big of a tax refund? So essentially, you've been giving the government what amounts to a 12-month interest-free loan. So can that be a bad thing?
Sam, you learn so quickly. That's exactly it. I mean, imagine we have that deal. We talked about this before. A lot of people do like getting big tax refunds, and the idea that we're getting more this year, the idea that we're getting more this year is excellent, because we really didn't plan on it. It's not something we could have planned on. So those people who are really strong stewards and don't like slow money or non-moving money, or giving the government too much money to get it back a year later, those people might be a little frustrated getting a lot of money back this year, but they couldn't have done anything about it, because it was the big, beautiful bill at the end of last year that got passed that's given people larger refunds. So that comes out really nice for everybody.
Right. The rules have changed.
Right. But your question is excellent. Yeah. Whenever possible. I mean, the perfect refund would be zero. If you need some people like the idea that they get this refund and then they use it to pay down the credit cards that they used all year long. That doesn't make sense. Instead of giving the government all that extra money all year round at 0% interest, loaning it to the government, and then borrowing on your credit cards at 29%, and then trying to pay it off a year later, well, you're paying all that interest. Don't do that. Try and adjust your income tax so that when the year comes around, you're somewhere around zero. If you're a few $100s over, or even $1,000, that's not bad. But, you don't want to have a huge refund, because effectively you're lending it to the government at 0% interest when it could have at least sat in a money market and made 4.3, or worse, it's sitting on a credit card charging you 29%.
Mark, what would you do if you're in that situation and you kind of have a feeling, hey, you know what? I think my employer's withholding maybe more than I would like them to. It's not the employer's fault, but it's just kind of the way it was set up. Do you just talk to your employer, or are there other steps that you need to do to get that remedied?
Yeah, you go to human resources and you fill out a new form. And by the way, most people don't know. Let's just say it's you and your wife, so you're married, filing jointly, but you could claim up to 99 exemptions if that's what it takes to get it to where you're breaking even on your income tax withholdings to be proper. So you can change that. You can put specific dollar amounts on extra withholdings and things like that. For example, maybe you own a small business and you also work full-time somewhere else. Well, if you own a small business, they may be asking you to do quarterly returns after a year or two of having that business, because your taxes were so much more than you paid in through your regular job. Well, you can go to your regular job and reduce your deductions down to zero, and then say withhold an extra $1,000 a month, so it covers all the income from the business too. That way you don't have to do the quarterly returns. There's all sorts of things you can do with it. You can adjust it to fit properly, is the bottom line. If you have an accountant, ask them how to do it. If you don't, then ask your human resource. Tell them what you're trying to do. I got $10,000 or $12,000 back last year. I'd like to reduce my monthly withholding by $1,000. How do I do that? Ask them to help you calculate that.
And Mark, here's an interesting question from a series that we just did on the Big Beautiful Bill. Is this higher refund rate that we're seeing, 11%, a result of the Big Beautiful Bill tax breaks, or is it something else?
Well, I think part of it is.
Yeah.
Part of it is, and part of it is, I think it's just everything. And the problem is, if you're if you're a numbers guy, if you're somebody who loves numbers, who loves details, this year's going to frustrate you, even though it's going to be positive for you. So, we'll have to get through a year yet more before we're happy with it, before detailed people are happy with it. For those of us who, just go month by month, day by day, and say, well, we're going to do the best we can as often as we can, it won't be as frustrating, but and you might even be overjoyed to get a little extra back.
Awesome. Well, Mark, unfortunately, the opposite of joy is sadness, and oftentimes sadness is mixed with stress. And apparently Sam has 7 charts that are guaranteed to stress us out.
I don't have these charts. Well, one, I don't want to be bothered to grab these charts, but I thought we would go through these items and just see if they do stress out Mark. So these are 7 charts guaranteed to stress you out about the stock market.
Sorry, go ahead.
This is from Market Watch. There's really 6 main items, but there's 7 charts. So I'll just read these off to you, Mark, and you let me know at the end if you are stressed out, as you are guaranteed to be, according to this article.
Sam, you stress me out.
There is a fine line between stress and excitement, and I'll let you decide where you're straddling right now.
So excited you're going to throw up.
Right. So number one reason to be stressed, apparently, is the S&P 500 is struggling right now to break above 7,000. Number 2, the Magnificent 7 ETF breaks below the 40-week average. Number 3, consumer staples or defensive stocks are on a tear right now, as opposed to the more aggressive stocks, I suppose is what they're trying to say. Number 4, earnings reports are causing huge swings this time around. Number 5, more stocks are climbing, but meanwhile, the S&P 500 isn't. And number 6 and 7, they kind of combine these together. They're calling it the midterm curse, and that is that midterm years have historically seen the weakest returns for all of the 3 major indexes. So, Mark, are you stressed out by these 7 things?
They left out there's 2 Friday the 13th and
that's
two
pretty scary too.
months as well, because that's as valid as the rest of them. So no, I am not stressed out, and I do not believe long-term investors should be either. This is what markets do. It's exciting, it's wonderful, but it's not stressful for those who are stewards, because we know investing is long-term. We know that God's in control. We know that we're utilizing His resources for His purposes to His glory. So wherever they come out, they're going to be perfect, because He already knew where it's going to be. So there's no stress in this. there's different. It's kind of exciting because we do see the markets actually leveling out a little bit, which is really good. Instead of being in 7 stocks, we're seeing it. Those stocks come down in price, and the money coming out of those isn't going into safety. It's going into other areas like metals and different areas.
Yeah, I thought that. The number 2 one, the Mag 7 ETF, breaks below the 40-week average. I was thinking, isn't that actually maybe a good thing? Because you've been talking about
it is,
that.
unless
you're in the
only
Mag
thing
7.
you own. Right, exactly.
Well, maybe we need to sue MarketWatch because they guaranteed us that we were going to be stressed, and we're just not.
Anything for a headline, and that's what happens here. Here, the number here is 610-363-1110. Even though I'm in Nashville, we still take the calls, and we're looking forward to it. So, John, we'll be getting to you in just a second. Thank you all for joining us from NRB in Nashville. We'll be right back.
My wife and I, we moved into this neighborhood. We had some experience with Crossroads Kids Club. We had served at another club. We kind of thought to ourselves, like, it would be really, really cool for us to actually bring in a club that was able to share the love of Jesus with kids directly into the school. And so we started our Crossroads at Hilltop.
Crossroads is amazing. You can learn all kinds of things about God. That He loves all of us. He died on the cross to pay for our sins. That He will help me in every way.
There is just such tremendous opportunity to reach kids in some of these areas that just aren't being reached.
Sometimes I pray every night. When I feel alone sometimes, God is right there sitting next to me. I can rely on Him no matter what happens.
Help reach kids with the hope of the gospel. Visit reachOurschools.com.
Every day, kids all across.
I will end the government policy of trying to socially engineer race and gender.
Diversity, equity, inclusion. Hiring on the basis of race and gender. You don't see the problem here?
What was once a widely practiced program is now being abandoned at an incredible rate.
We will forge a society that is colorblind and merit-based.
Companies are making big changes.
Money talks, so why not have it advocate for what you believe in? Get started today at financialissues.org.
Are you tired of the chaos? There are a lot of things that make noise, but only a few that truly matter. As a parent, I want to leave something that will last for a long time.
You invest $300 a month interest on unmanaged by the time you retire.
Not just an inheritance of money, but a legacy of godly values.
Here at Financial Issues, we want to help you grow your money, but our main goal is to help you honor God with the money that He's given you.
Invest your money in a God-honoring way. Go to financialissues.org.
Well, I'm going to give a real...
Folks, give us a call, 610-363-1110. Mark is live from the National Religious Broadcasters Convention. Very cool stuff. Keep him in prayer as he gets the word out about financial issues. Pretty awesome. 610-363-1110. Mark, let's go to the phones, shall we? And talk to John.
Let's do that. Hey, John, welcome to Financial Issues from Opryland in Nashville. What's on your mind this morning?
Yeah, I was wanting to talk about that diversification. I thought I was under what we're
under diversified, John. Is that what you're talking about?
Yeah, under diversified.
Sure.
in because the way that our portfolio is set up is with FISM, and we have the mutual funds, and then we have the mutual funds, but some of the mutual funds have the ETFs. So,
John, you may not be under diversified. Remember, a mutual fund is a bucket that holds a whole lot of different investments. So let's just say you're in the Timothy Plan Small Cap ETF. If you're in that, you have 60 to 150 different stocks that you own in there. So that gives you the diversification. The manager of that ETF is doing the diversification for you. So if you own 3 or 4 or 5 different mutual funds and ETFs in your portfolio, you literally have hundreds of stocks. You're well diversified, in asset class and in sector. So you're doing really well, actually.
Yeah, well, when my wife and I got together, she had the American funds, and it seemed like all those American funds had the top 10 were all the same. They were just not in the same number. You know, they had, I ain't going to name them.
John, I'm sorry. On my end, we're in a convention center, and I'm losing your voice on that. So, Seth, I think you can hear him okay, right?
I can, Mark. Yeah, John was just saying that his wife had some American funds. John, I didn't really catch your question there, based on what Mark said. Could you just repeat that question one more time?
Well,
what's your concern?
Once upon a time, we had those American funds, and all the funds had the same top 10 companies in them, but they were just at different numbers, you know, and that was, I was like, we can't do that. But then we found you guys and we changed everything. But it was, you know, why would they want to do that?
So, Mark, the question is, why would American funds do that?
Yeah, American Funds has some very good managers in them. Unfortunately, they're not biblically responsible. And depending on the fund that you have, because they have so many funds, they may overlap a whole lot. Now, with the Timothy plan, there could be some overlapping too. But if you're in a small cap fund and you're in a large mid cap fund, most of those will not overlap because they're 2 different asset classes and different stocks fit into different asset class. If you're in if you're using the high yield fund as well, that's going to be different than the normal mid-large cap because it's going to be primarily those stocks that have higher dividends in them, though there might be a little overlapping. So again, I think you're well diversified if you're using the fund strategy on the financial issue site because it's using primarily Timothy plan, and Timothy plans are divided up into asset classes, and they shouldn't be overlapping as much as you saw on American funds.
John, is that the model that you're using?
Timothy plan is pure, clean.
Yeah, exactly.
So you get both.
Yeah. Does that
Did
make
that
sense,
help, John?
Yeah, but I'm using the stock funds and the mutual funds.
Yeah, and that's okay. I like the idea of using stock funds and mutual funds at the same time because what happens is you broad brush with the mutual fund. Let's say a small cap fund, the Timothy Plan small cap, you broad brush and you have 60 to 150 different stocks in there, and then you go and you buy a stock or two in certain sectors, which are hopefully favored sectors, like we're seeing industrials and common metals and things like that. So it's a good thing. I think you're okay.
Yeah. Mark, is it safe to say that for someone like John, John, you mentioned you're in a couple of the Timothy funds, or in Timothy funds or Timothy ETFs. If you're in one or two of those, you've got built-in diversification. Mark, is that correct?
Well, yeah, I agree. I think that's true, and I appreciate what you guys do. Thank you very much. Have a blessed day.
All right, John. Thank you for calling in. And Seth, just so you know, my in-ear monitors are going in and out as we're doing here. Yep. So I'm assuming you're getting it all, so you might have to catch me off when they pop back in. Okay.
I think that made a lot of sense for John, Mark, and I'm so grateful that he had called in. Mark, I think that a lot of people wonder that. We've been getting questions about that where people wonder, if I'm in the fund model, for example, and I've only got 1 or 2 or 3 of these mutual funds. You explaining it, I think, is so important. Certain Timothy funds, like you said.
Okay, I don't know if you can hear
100.
I don't know if you can hear me, Seth, but I've lost all in-ear.
Okay.
I don't
Tell
have
you what,
anything
why don't we do this, guys? Let's get Mark.
Oh, there you
connected. There he is. Hey, Mark, can you hear me?
Yeah. Hey.
Awesome. Good stuff. Yeah, Mark, sorry. I was just saying there, it's just a good reminder for us to know, okay, what is a mutual fund? How does it work? Like you said, it's a bucket of a bunch of different investments. If you're in even one mutual fund, one of the Timothy funds, you've got built-in diversification. You can breathe a sigh of relief. It's a good thing. Yeah.
There you go.
Makes sense? Good stuff. Well, Mark, we're going to keep on trucking on here. Why don't we get to Charles's question? I think it's a good kind of springboard from what we just talked about with John, because Charles has the opposite problem, Mark. So he says, hey, Mark, over the last year or so, we've had a model change and changes in the market requiring some portfolio rebalancing. As I've made these changes, I may have become over-diversified. So I've got 65 stocks now in my IRA, 65, possibly even more than that. How do we handle portfolio balancing to avoid this over-diversification? If we only buy from the buy list, how should I approach consolidation, await sells, merge only to the buy list? Thank you and God bless. So, folks, we just lost Mark there, actually, so we're going to try to get him back there. But while we're talking about this topic, Charles, let me just address this for you, because this is a really good, I think, kind of teachable moment for us on the idea of having good diversification. So diversification is good, but what about over-diversification? What about if you're too diluted, as it were? So, Charles, let me just say this. I commend you right off the bat for seeing that your portfolio may have become over-diversified. And I think the lesson here when we're talking about over-diversification...
And reminder, he has 65 stocks.
Yeah, he's got 65 stocks.
That's quite a few stocks.
That's a whole lot. Too much of a good thing can be too much. Too much of the Lord... Don't worry about that. Too much reading the Bible, don't worry about that. But too much diversification can be too much. It can be a bad thing. And there's another risk. It's not the risk of under-diversification where you're going to be, moving with the upswings and downswings of the market. But the risk of over-diversification is dilution and cutting the potential for growth out of your portfolio. So if you're really, really thinly spread across all these different holdings, there's just not as much of an opportunity for you to really grow there. Additionally, you're also going to get kind of hit with, if there's a lot of dilution, that means there's a lot of mediocre holdings that might be pulling your portfolio back a little bit. So yes, Charles, I would say 65 companies is probably too much. 65 is probably too much. Without seeing your exact allocation and your exact holdings, let me give you a couple things that you can consider doing to move from over-diversification to proper diversification. The first thing to do is act on the sell alerts as they come. My guess is, I could be wrong on this, but if you've got 65 companies and they've been on the buy list at one time or the other, maybe one or two of those we issued a sell on. I'm not saying that we did. There's a lot of options on the buy list right now and many more that are on the hold list too. But maybe there's one or two that are sells. Go back and look through the sell alerts. If you have a holding and you don't see it on our buy or broad list, that's a good indication that we probably held it at one time and then issued a sell alert. So check and see, start the kind of make that your first kind of line of defense there. The second thing to do is to look for those companies that are not performing as well that we talk about on the show and consider selling those ones off. There might be companies there that might not be the terrible companies that you see that are just dropping like a rock, but they don't have as much of that financial issue steel that we're talking about. Maybe they have high debt. Maybe they have some other things going on that just don't seem to be good from a long-term perspective. And you can always call in and ask us about these specific companies if you want to. If they're not profitable, if you've held them for years and they're just not growing all that much, you can divest from those companies. You can trim those back a little bit. Look at your brokerage statements, sort from least to greatest. Here's a good metric for you. And Mark, you can tell me if you're back now, you can correct me if this is wrong. A good metric for the number of holdings in your portfolio that would be kind of a limit is, I'd say, no more than 40. That 20 to 30s range, Mark? Is that right?
Yeah, that's a good range, actually, because that gives you up to 3% entry point. And if you do that at 3%, that's 33 1/3 stocks you could be holding. So, yeah, anywhere between 30 and 45. I'd say 20 and 45 because, some decrease and sometimes you get a little bit over in too many or too few sectors. So, it's good. Yeah, awesome. 20 to 40 makes total sense, Seth.
Mark, tell me what you think of this, because I think we were getting you back on when I answered this part. The dangers of over-diversification. What I told Charles was one of the dangers is that you just kind of cut the legs out from your portfolio where you can't get as much growth potential. Are there any other dangers that you can think of being over-diversified?
Yeah, that's exactly what the main danger is. By being over-diversified, it makes it harder to stay on top of everything, for one, but you can diversify down to zero. The whole idea of diversification is when one area is doing poorly, hopefully other areas are doing well. That way it takes some of the bottoms, some of the valleys, and some of the peaks out of there, helps that roller coaster ride of the market to smooth out a little bit. That diversification is one form of risk management. Another form is to stay on top of your portfolio. Well, if you have 90 or 100 different stocks in there and you're going to rebalance or look into, let's see, should I be still holding this or selling this or buying this? You have 95 to 100 stocks you have to go through instead of 30 or so. And to be looking at the financial issues, steel or its potential. So it could get a little overwhelming to have that many stocks for an individual, unless that individual, that's all they do is manage their portfolio. Kind of like Sam.
Yeah, that's exactly right. Even Mark, I was going to ask, for a professional money manager, is 65 kind of the norm, or is there more than that or less than that? Because that seems like... a professional money manager is looking at hundreds of stocks all week long. They're going through all the different stocks, that the potential to put on the buy list, those that are on the buy list or the hold list, to make sure they're still worthy of being held by their portfolio. So it's a lot more. But that person is working every day. 8 hours a day, 7 days a week to make that portfolio work for you, and usually have assistance as well. And we have assistance here on the phone. The number is 610-363-1110. Give us a call. Join us at the convention. We'd love to hear from you.
In the last 10 to 15 years being in ministry, being married, something that has been constant in our lives is Samaritan Ministries. As we've moved, we've had babies, we've had different things come up, we have just been able to rely on Samaritan in ways that we never really even thought about before becoming members.
Our heart's desire is to plant roots and be in a place for a really long time. It's how we were raised. We see the benefits of that, but we also see the open-handedness of being used by the Lord wherever He calls, because we just assumed when we started pursuing church planting, the quickest way to get from point A to point B is a straight line. And with the Lord, sometimes you find out it looks a lot more like this. And yet, Samaritan was with us through the entire thing.
We didn't have to look into, we have to change insurances now because we've moved states or whatever the case may be. And it's just been a real blessing to us in different phases of life.
I'm Kyle.
I'm Colleen.
We're the Gen X.
And we're Samaritan members.
Navigating through investment options can be challenging, especially when you're determined to uphold your God-given values. Every dollar you invest is a vote for the world that you want to live in. Let your values guide your investment decisions and help to shape the culture in which we live. Become a beacon of light and pave the way with biblically responsible investing. Timothy Plan, where faith and finance collide. Before investing, carefully consider the fund's investment objectives, risks, charges, and expenses of the investment company. This and other important information can be found in the fund's prospectus. To obtain a copy, visit timothyplan.com or call 800-846-7526. Read each prospectus carefully before investing. Investing involves risk, including the potential.
Folks, we would love to hear from you. I know Mark would love to hear from you down at NRB. So give us a call, 610-363-1110. Hey, Mark, I did want to talk about this real quickly before we get back to some more questions here. We are so delighted and honored to be partnering with Preborn all the time, but especially now around Valentine's Day as we're trying to become heartbeat heroes and to save the lives of babies and bring mothers and fathers to faith in Christ. I'm so excited to announce, as of this far, we had a great day yesterday. We're up to almost $14,000 to our $21,000 goal, 88 gifts. So those of you who have given, thank you so very much. Every gift
two-thirds of the way there.
Two-thirds of the way there. We're as expected. The cavalry comes with the FISM family in the back half. As the twilight comes, the cavalry comes. So it's exciting. If
they like to build anticipation.
Yeah, it wouldn't be fun if there wasn't some anticipation. Right?
I don't know about that.
Right. But yeah, we just appreciate you all so much. If you're on the fence and you want to make a donation to Preborn, just go ahead and do it right now. Preborn.com/FISM, easiest place to go. You can also go to our website and click the Preborn banner, Heartbeat Hero banner right there, and it'll take you where you can give securely. Good stuff.
Absolutely. I can't think of a better organization to partner with. One that is doing so much for babies, for women, for the gospel. It's all right there. It's so wonderful.
Yeah.
You need to join us. Become a Heartbeat partner. I'm one. You can become one too. Just go out to financial issues, click on the banner, and just give. Give whatever the Lord puts on your heart. It doesn't matter how much. It could be a little, it could be a lot. But just remember, every time you give, that's an ultrasound machine that is going to be put in somewhere where a mom can hear her baby's heart, can see her children in the womb. And once a mom sees her baby, hears that heartbeat, they fall in love with that child. And now we have another of God's creations to walk this earth. It could be the next, the person who cures cancer, the person who ends war, the person who spreads the gospel, that next child. So join us. Become a Heartbeat hero.
Yeah. Amen, Mark.
Well said.
By the way, there's a QR code on the screen, so if you hold up your phone to the screen, you should go right to the website and donate right there.
Perfect. Thank you, Sam. That's awesome. Yep, check that out there, folks. Do that. All right, Mark, good question here coming in from Pete, 65 years old. I think this is Pete from Seattle, one of our faithful partners, saying, hey, Mark, during one of your summaries of tax reductions associated with the big, beautiful bill, I was surprised to hear you speak favorably about the increase in SALT deductions. Now, this increase subsidizes taxpayers in high-tax states at the expense of taxpayers in low-tax states. I think people in high-tax states who are unhappy with their tax burden should address it at the ballot box, not by shifting the burden to others. Mark, your thoughts?
Interesting, Pete. I really appreciate that, actually. But I think what's happened is federal and state laws have gotten us into this position of thinking that what the argument should be. And really the argument should be, how do we lower all taxes? Not why does this state get to lower their federal taxes by deducting their state taxes, and this state doesn't because their people didn't. When we go to the ballot booth, both in state and federal, we should be voting down. You wouldn't believe how many times in St. Louis I see all these bills on there to raise taxes, and people are voting them in and then whining and complaining about the government taking their money. They'll make it sound like, well, if you don't vote for this school district is going to have to shut down the football team, or they use.
Well, I get one, Mark. I went in. It was like, do you want to go in and buy new fire trucks for the fire department? It didn't tell me how much that they cost, or if we even really needed them. Like, how many fire trucks do we have? But I'm sure people go in there and they think, well, sure, the fire department's a good thing, so I'm just going to vote yes.
Yeah, exactly. So, Pete, I agree with you. It feels wrong because it feels like we're those states that don't have those salt tax situations or don't have state tax, feels like they're subsidizing the rest because they lower their income tax. But the reality is lowering the income tax should be across the board. That's one of the things I like about Trump. He's trying to lower the income tax. I've heard him say way too many times, because nobody's listening, that wouldn't it be great if we had no income tax and we just had tariffs or other ways to do it. I like that idea. I also understand why you feel that way. It doesn't feel fair that some states get a little benefit that other states don't, just because they charge state local taxes. So I agree with you, and yet I don't think that's the right argument. I think the right argument is, how do we lower our taxes? And we lower our taxes by getting people in our state and in the federal government, in our Congress, who know how to balance a budget, who know how to pass spending bills during the year that they're supposed to be passed. We vote out those people who are fiscally irresponsible, and we vote in those people who are true stewards. That's what we need to do. So effectively, Pete, I'm on your side, and at the same time, I think they got us way too often arguing about the wrong things. We need to be looking past the shortness of who gets a deduction and who, when other people don't, and get on to, let's get our tax situation in order so we don't have to have these conversations. I hope you agree with me, Pete, but I do know where you're coming from.
You know, Pete, we would love to get to hear from you to respond even to Mark's question there. And anybody, by the way, you can call in at 610-363-1110. Since I'm here, Mark, and I get the privilege of talking to you every day, I'm going to respond to it because I can.
Okay.
And I'll say that I agree with you completely also. And I'll throw this one at you also, Mark. We talk a lot in politics, and especially as it comes to economic policies, about ground up change. So start at your local level, start in your state, start in your district. But we also can't forget that sometimes politics works the other way around, where we've got to get, we need the president to do his job, and he needs to enact policies across the 50 states. So I would argue that, you know, say a state like California or New York that has a really high tax burden. Trump should be allowed to address that in some way, and he's trying to do that here. Absolutely.
Well, he needs Congress, though. That's the main problem.
Yeah, it's not the president's job to do that. That's Congress's job. It is the House of Representatives who controls the checkbook. They're the ones who pass the laws. The Senate and the House have to do that. That's why you hear me go on rants all the time, and I'm not going to let you trick me into it today. But about the House of Representatives doing their job. But you know what?
It would be really helpful if...
I'm seeing them starting to react. I'm seeing them start to move forward and starting to get things done. And that's
they need to watch Schoolhouse Rock, Mark. They just need to go back and watch I'm Just a Bill, and I'll learn how that's done and then start doing that.
Everybody who gets elected to the House should have to go watch
that. Should be orientation.
Right.
Like, that's the first thing you do. You come in, they pop in the video, you memorize the song.
Instead of going room to room talking about all the people who are going to back you in the next election and telling you what you need to do to get that backing.
Exactly. Yeah. Maybe watch Mr. Smith Goes to Washington, too.
There you go. There you go.
Good stuff. Pete, give us a call back if you've got a comment about that, and any of you as well, if you're interested in joining the conversation about the self-deduction or anything that we're talking about here. Mark, let's get to another question here. This is Madeline. Madeline's 68 years old, saying, hey, Mark, good morning. We're new to investing, so thank you for your time and help. My questions are this. Our asset allocation model is the FISM growth and income model. Do we only buy stocks that are listed in the growth and income style? And also, are there any suggestions on what to avoid?
Oh, that's a good question. And I'm sorry that that's not clear on the back end on our Partners Hub. We should make sure that is clear. But the reality is, you're in the best. You can invest in growth or income or growth and income styles. And the reason for that is because as a growth and income investor, you're really in a transition portfolio between total growth or total income. Usually that happens around 50, 55 as you're getting closer to retirement. You go into growth and income to try and have a little more diversity, so that and bring in some income to try and bring down the volatility in your portfolio, because you don't have as long to recover from it. Well, if you're just getting into it, you may want to buy into some in the growth and income portfolio, buy some of the growth things instead of just growth and income labeled ones. A growth thing would be a stock that doesn't have dividends on it. growth in income would be a dividend-paying stock. So you might want to lean a little more towards growth as you get older, or you get closer to retirement, or you start feeling that tug at your heart from to get more conservative. Then you start moving more towards the income portfolio items and less towards the growth items. So you'd be more income and growth in income there. So that's why it's there, because that portfolio could be contoured around your sleep factor and your time horizons to make it work for you.
That's awesome. Madeline, let me just address your question about what to avoid. Like Mark said, you've got the freedom to pick what you'd like.
Aggressive.
Yeah, right. Maybe avoid some of those aggressive ones. Those are more for me and Sam. But no, Mark, I mean, honestly, in the growth and income model, you do have the freedom to be more or less heavy-weighted one way or the other if you want to. The one thing to avoid, Madeline, is anything on the hold list. Don't buy anything from there. Only buy from the buy list.
The buy list, yes.
Exactly.
Well said, Seth. Well said. Glad you pointed that out. Yeah.
Well, Mark, I'm excited because I know Madeline has been asking several questions. She's a new partner, and it's always exciting to see someone beginning. Never mind the fact that you're beginning in your 60s. It's never too early to begin. It's awesome. Really good job, Madeline.
Right, and we're seeing more and more new partners signing up, which is really good. Yeah. You want to become a partner. If you're even thinking that you want help with your portfolio or learning to invest and learning to do it yourself instead of paying somebody a fee to do it for you, you can do it because we do all the research in the background. We look through the stocks, we come up with the buy, sell, hold lists, and we come up with the asset allocations for you. And then we help you gently move into it. And the sooner you get involved with it, the better. Just like the sooner you get involved with the show here by calling 610-363-1110, 610-363-1110 to join the show. You have 15 minutes left, or you're going to have to wait, as Seth says, another 24 hours. We'll see you in just a little bit here.
My wife and I help lead a Crossroads Kids Club, and one of the girls, she said, Mr. Dave, you keep talking about like you didn't really believe in Jesus and you were like dead or something, and then like you believed in Jesus and then you're like alive, and I want to receive that. And so we just prayed there in our group to receive Jesus and owning this idea of life with Jesus for the first time.
Help reach kids with the hope of the gospel. Visit Reach Our School.
As a member of Samaritan Ministries, your monthly share is a gift that goes directly to a real person in need. While that share takes care of the financial portion of a need, medical needs are complex and include the physical, mental, emotional, and spiritual aspects as well. While the financial gift is important, if we stop there, we miss an opportunity to minister to the whole need of our brother or sister. When you faithfully pray and send a note of encouragement.
The opinions and recommendations expressed on this program do not necessarily represent the opinions of the station or any of the program sponsors. Additionally, all products or services offered by the program sponsors may not be known by the program.
610-363-1110. Folks, your host, Mark Minnella, is live from the National Religious Broadcasters Convention. Mark, I'm excited to hear the updates and hear who you get to have conversation with. I know you have a lot of interviews lined up, brother, starting this afternoon and into tomorrow.
We do. It's nonstop.
Yeah.
It's nonstop for 12 hours a day, it seems like. And it's going to be a lot of fun because I do have my cell phone, so we're going to do some social media clips walking around so people can see what's going on here and how exciting it can be. And you know, one thing is very, very exciting about being at NRB is seeing how many organizations that love the Lord are taking it serious to be in the media and to get the word out there, the gospel of Jesus Christ through the media, using all the technology that's available to reach people for God. It's just awesome.
Well said, brother. Excited to hear about that. Folks, by the way, Mark had mentioned, doing some social media clips. Make sure that if you're on social media that you give us a like and a follow. Financial Issues. We're on YouTube, Facebook, X, Rumble. Am I missing anything, Sam? Instagram. That's what the
Elijah reminded me we're on Truth Social.
Truth Social as well, if you've made it on the Truth Social. So, yeah, give us a like and a follow. Give us a repost or a retweet or whatever you do. And be on the lookout for those.
We're on our own website. You can go out to financialissues.org, watch us live, get in the chat with us. We have hundreds in the chat every time we do a show, and you can join in and you can ask questions, or you could just kibitz with all the other people in the chat.
Absolutely. Mark, speaking of the chat, I'm going to throw a little something in here that wasn't in our show notes, but we're going to do it anyway because this is a live show after all.
Let's do
Nathan
it.
Nathan from
Seth, you're making it too easy for him because I told him to call in.
I'm sorry.
We're nice. We're nice like that.
I know. I want to meet him where he's at. Nathan is saying, what should I do, Mark, if I don't have a stock in a sector that doesn't have anything on the buy list currently? He's thinking of consumer staples in particular. This is one of the problems when having a small portion invested. I think I had a little more a while back, and I'm trying to inch back in some of the things of when to buy, when to hold, things like that. The answer might be in some Timothy funds, but Mark, let's hear your thoughts. What should Nathan do?
That's an excellent question. Sometimes there isn't anything worth buying in a sector. I know that's even when it's a favored sector. Mostly the issue could be that the BRI issue where a lot of the stocks are on our sell list because they're not BRI compliant.
Mark,
they don't honor God.
Weren't you saying that this sector, consumer staples, has like the most ratio of non-BRI stocks, something like that?
Well, I don't know if I said that or not, but that's what it seems like.
Yeah, it might not be the exact number, but it seems like that.
Right. Every time I find a stock that I like from a fundamental and technical perspective, it's dirty. So a lot are eliminated there. But then those that are left, maybe at this point they're overvalued, so we're not putting them on the buy list at this point. If something's overvalued and we put on the buy list, and it's going to take 3 years to grow into its value because all the money rushed out of, let's say, software into that area before we got in on it, before you were able to buy in on it, we wouldn't have it on the buy list, just from the taking too long before it catches up with itself. So we're working on it. We try to fill those areas, especially when we believe they're a favored sector. So don't worry about it though. It's okay. Sometimes it's all right not to be in a sector, especially if it's unfavored, meaning that money's just moving out of it and the stock just is going down continuously for the last 2 or 3 years. It's all right if we don't have something in there. What we're saying by not having something in there is there's not anything really worth buying at this point in that sector.
Good stuff, Mark. I appreciate that answer a lot. 610-363-1110. Mark, we've got a call coming from North Carolina.
I know.
Let's go to Dakota. Dakota's calling from North Carolina.
I love that name, Dakota. Welcome to the show. What's on your mind this morning, Dakota?
I'm very new at stocks. My father-in-law called, I think he said Friday, Justin from Texas. But I'm trying to learn how to trade in stocks now in a short period of time and not get nipped in the butt, if that makes sense.
It surely does. So what's your question then? Where to get started or how to get started?
So we had a conference call last night about it, and I just need a car because I'm a Marine, And
thank you for your service.
Yeah, thanks for serving, brother.
Of course. And we need another car because we had a kid, and so I'm just trying to make some money off of my bonus I got in a shorter amount of time instead of a long amount of time. So like how to do that, really.
Yeah, this is a catch-22, really, type of question. And maybe that's a saying that many people don't know anymore. But the idea here is...
I know it, Mark. I got you.
Okay. Wanting to make quick money in the market makes it more like a casino than an investment. That's a problem. You can make quick money in the market, but unfortunately, you can lose a lot, too, very quickly. We look at more long-term investing as more of a long-term thing. So when we say that, when we find a stock we like, it's because fundamentally it's strong. Its earnings, its profits are there. They're doing the right things internally. We're seeing price to earnings be balanced, not through the ceiling like some of the bubble stocks, things like that. So we're trying to recommend stocks that you could get into and watch them grow over time, not shoot up like a bottle rocket, explode, and then fall back to earth, because that's way too dangerous for most of the people we know who are with us, who want to invest. So I'm trying to balance this out and think of a way for you to be able to take the bonus that you have and get another car, because it sounds like where you're at right now, obviously you don't have the savings there to buy cash for a car, a decent car. And if you don't have the savings there, you probably don't have that moat around your castle that we talk about, the liquidity that you need to not have to use credit card or debt. And if that's not set up, then you really shouldn't be investing at this time unless it's through work in your retirement plan or something. So the first step to investing is to build that moat around your castle, and that moat around your castle is a savings account, a high yield money market account, something that you have the money there so that when things break down or emergencies come up, or let's say you don't re-enlist, you're out of the service and you're looking for a job, you don't have to panic because you have money there to get you through it. Part of that also, a broader part of the moat around your castle could be saving up for a car. But I'm hearing a little bit of no, we need the car now. So unfortunately, the only way to do that would be to have to borrow to buy that car. So if you have take your bonus, use it as a down payment, make sure you buy a used car, find one if you can find one with low miles. The good news is, in the last year, one of the number one areas of what Trump has done is used cars actually have reduced in price by 25% over the last year. Not just reduced the inflation rate or how fast they were rising, but actually came down around 25% over the last year. So you're in a good place to buy a car. So here's my advice. I hope, Dakota, I'm not breaking your heart with this, but start preparing that savings account, for those emergency things that you and your family are going to need to maintain, to make sure you don't have to use credit cards. If you have to borrow to get that car so you can get back and forth to work, get on your knees and just pray and ask the Lord to help you to figure out how to do that and how to find that kind of car. I actually had a friend who did that, and within 2 weeks, somebody actually just gave him a car. So that kind of thing does happen. We have an awesome God, especially when we're trying to honor Him by not going into debt, by heeding His warnings and concerns with debt. And I'm not beating you up on that, Dakota. You understand that, right?
Yeah.
Okay. So you do what you can do. But before you start putting your money into like a Roth or an IRA or even a 401k at this point, start building up a savings. Now, there's rules of thumb that say 3 to 6 months worth of income, that kind of thing. There's a broader way to do that. And if you get in contact with us, I'll share with you a form on how to set up and calculate what you need in that moat around your castle and how to set it up so it's systematically going in there. But just the rule of thumb would be start start saving a little bit every month so that you can start building that up. And that way, when the car breaks down or when you need something, you have the money there for it. Okay, that's before savings, and I wouldn't look at the stock market as a way to make quick returns, because way too often it does happen that people do talk about the returns that, man, I went into this, I made 300% in 2 weeks, and it's like, yeah, that does happen, it really does. But you know what else happens? I went into this, I lost 75% of what I put into it in 3 weeks. So you want to be careful with that. That's why investing should be longer term. Things that are needed for short term, we just need to be prudent, depend on the Lord, do the best you can, and I think that God will provide for you, because He loves you, Dakota. He loves you and He wants to care for you and your family.
Absolutely.
And when you heed God's call, sometimes our lifestyle won't be what we want it to be, but it'll be what it needs to be in the right place to honor God with all you have, including your savings, your income, your investments. And it sounds like you want to honor God. So God bless you, sir, and thank you for your service. Thank you for being with us, and thank all of you for joining us from NRB here at Opryland. We're glad you joined us, and we look forward to seeing you tomorrow. God bless everyone.
If we ever forget that we're one nation under God, then we will be a nation gone under.
Thank you for joining us. This has been an FISM production.